on the downside. And State Bank of India, though, not doing a whole lot. We're down about a fifth of 1%. Has.
And one, of course, the banking sector in India continues to weigh on the overall economy. Let's take a look at the outlook for Indian banks. We're joined by Bloomberg Intelligence Asia financials analyst Diksha Gira. She joins me here. And from Mumbai, it's Saswata Guha, Director of Financial Institutions at Fitch Ratings. Thank you both for joining us. First, Diksha, ICICI earnings expected. When you take a look at this particular bank, what kind of trend are we looking at?
Yeah, so I think as you've noticed with a lot of Indian lenders, asset quality still remains a driver of earnings. Yes Bank reported a 9.4 billion provision last night, which actually took it into a profit decline. Sadly, this is true that ICICI is also likely to see higher provisions going forward, and the banks are also taking hits on their bond portfolios. So yeah, there is some more pain to go.
Saswata, Diksha was talking about high provisions. We've been seeing this for years now. Why has there been no improvement?
Yes, hi, good morning. Well, one of the reasons why we have been seeing this for years is because one, of course, is banks have been slow to recognize bad loans. So a bit of that is currently catching up. And again, I think while yes, I think many of the banks are seeing a slowdown in the pace of new NPLs. I think the existing stock of NPLs is seeing what we call as NPL aging. So as they move from one bucket, one aging bucket to the other, it attracts higher provisions. And that's precisely what we are seeing across banks currently.
Of course, Fitch has a negative sector outlook for Indian banks. Systemically, nothing has changed. How long can this go on for?
Yes, well, we have had a negative outlook on the Indian banks for several years now. Although I would say that sometime around September last year, when the government came out with its, recap plans, we were perhaps a little less negative. Of course, I think subsequent to that, there have been regulatory changes, and Indian banks posted another year of large losses. So I think we're pretty much back to square one. Of course, a lot of this negative is being driven primarily by the state-owned banking space. Although yes, private sector banks have had their own share of the problem, but clearly it's still a weak or rather a poor capitalization issue. And given the fact that we continue to look at fairly bleak earnings, I think the negative outlook is perhaps justified, at least for the near term. And we would continue to obviously look at the situation. The only silver lining here is that one, or rather two silver linings here, is that at least the pace of NPL growth has seen some degree of slowing down or stability across the banking system. And two, I think irrespective of what has happened in terms of the balance sheet, I think funding continues to be a strong point, particularly for the PSU banks and as well as for the private sector players. But I think given the uncertainties around earnings and capital, I think the negative outlook will likely continue in the near future.
A question for Diksha here is Rish in Hong Kong. Asset quality is the absolute bottom line here. This is the driver. Are we seeing any improvement here?
Yeah, hi Rish. See, sadly that is true. Asset quality invariably is determining whether banks are reporting a profit or the profit is growing or not. So we see that as continuing to be one of the drivers, at least in the near term. But what is interesting is that there are some other divergences that could emerge, like especially within the private sector banks that Bloomberg Intelligence covers. What we see is that the banks with stronger deposit franchises, their funding will actually prove to be an advantage for them. And we could actually see some of the stronger deposit names like HDFC Bank, Axis, even ICICI, they could start seeing positive news from the margin front of things that could help in terms of earnings growth.
So Swata, give us an idea of how you're rating these different banks. Who are the ones that you are seeing better performances of and a better future for than the others in terms of ratings at least?
Yeah. Well, let's talk about the private banks first. I think those are rated at the same level as the sovereign, and they continue to be driven by what we call as their standalone intrinsic risk profile, which is again rated at the same level at BBB minus. But having said that, clearly their individual risk profiles have come under pressure. As you would have probably seen, that Axis Bank's default rating is currently on a negative outlook, and that's largely stems from the risks we see to the capital on, due to the significant deterioration in terms of asset quality as well as earnings. But having said that, I think if one were to sort of go by the first quarter numbers and based on what just Diksha mentioned, our expectation is that at least both ICICI and Axis should start showing some degree of stability, perhaps this quarter and the next. So from an overall pressure perspective, we are certainly not seeing any further deterioration from where it is already. But clearly, I think the individual profiles have certainly taken a hit. Also, I think the issue around governance, I think that continues to be a key qualitative input into our ratings. And I think in the case of private sector banks, that has obviously come under the crowd in recent times. Coming to the public sector banks, clearly, I think those are driven by support because their default ratings are all rated at the same level as the sovereign. Although if you sort of compare them to the standalone credit ratings, there are divergences as big as even 7 notches, which clearly goes to show that at a standalone level, those banks are clearly doing fairly poorly.
So Swata, go ahead there, and Diksha joining us there in Singapore. Let's have a look ahead to some